Well, hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. I'm very happy to have all of you with me today as we talk about Chapter 2, which is Analyzing Business Transactions. Here in the room with me, I have about 13 of our colleagues are with me today, and I'm very happy to have you with us. So I just want to call your attention as to where we are in the classroom. We're still in week 1. Today is August 24th, which is week 1. You'll notice that week 1 ends on Sunday night, which is August 27th. There is a couple of things that I need you to complete this week that consumes quite a bit of time. So I apologize about that part, but it's really important that you get it done. You'll notice that in week 1, under the Engage and Explore, in addition, the Excel exercises, those are just for practice. You do not need to submit those. But you will notice there are 2 other things in Engage and Explore that you do need to complete. One is the Excel Essential Training. So it should take you about an hour and a half to get through that. And then when you're done watching all of those videos within the Excel Essential Training, you'll be able to download your certificate and as a PDF, and then you want to upload that right here. So you'll once you've downloaded your once you've downloaded your Excel LinkedIn Learning Essentials Training Certificate through the PDF, you'll upload it here by clicking on here, and then you'll upload it for your submission. It's kind of like a Dropbox is the way it should look on your side. And I see that 6 of you have already done that, and I do appreciate that. It is graded. It's worth a good amount of your grade, so I do need you to complete that. Yes. And if you have questions about registering for LinkedIn Learning, it's very straightforward. All you need to do is go to Start here, and then come down to LinkedIn Learning Activation Instructions. Watch the short video, or you can follow along using this PDF. It's about 9 steps for you to activate your LinkedIn Learning profile and connect it to UDC. You'll use your UDC login credentials, and that'll help to it basically links your LinkedIn profile to UDC's learning platform, which is how we use LinkedIn Learning. Don't worry, UDC doesn't see anything that you post. Okay, so that's different. That's a different system. Okay, different platform. So don't worry about that kind of thing. That is part of the requirement for this course. So please make sure that you do that as soon as you possibly can. I see a lot of you are active in the introductions discussion. I do appreciate that as well. So back in week 1, once you've done your Excel LinkedIn Learning training, you'll upload the certificate to this Dropbox, and then you'll also need to participate in the Chapter 2 discussion. But of course, we'll do that after we talk about Chapter 2, which is what we're going to jump in right now. You should also be completing the Chapter 1 quiz and the Chapter 2 quiz. All of this needs to be done by Sunday night. Okay, so there's a lot going on in this classroom. And so there's a lot of things we need to do every single week. There's usually at least 4 action items in every single week. So understanding that, knowing that there's a lot of work to be done in this course. We only have 8 weeks. So do your absolute best to stay on top of it, because if you fall behind, it's going to be difficult for you to catch back up. So that's why I'm trying to urge you to do the best that you can to get things done on time. And so with that, let's go ahead and jump into our Chapter 2 discussion, which is analyzing business transactions. And I'm going to start from the beginning. Here we go. Okay, and of course, as always, for those of you on the call, please feel free to unmute your microphone and ask a question anytime that you have one, so that way we're able to help you accordingly. Yeah. So some reason it always likes to do that. There we go. Thank you. Okay, so like we talked about in the last chapter, in chapter 1, we talked about the accounting equation, remember? And there are 3 parts of the accounting equation. Can anyone on the call today, can you tell me what is the accounting equation? Remember the formula? What is the accounting equation? Who would like to answer that question for me? Leland, go for it.
Assets equal liabilities plus equity.
You got it. Yeah, exactly right. Assets equals liabilities plus equity. So thank you, Leland. Appreciate that. Who can tell me what is an asset? What is an asset?
It is the economic resources owned by business.
Yes, it was that. L'Oreal, was that you?
Yes.
Okay, awesome. Thank you. So yes, it's what the assets are what's owned by the business. Assets include things like cash, accounts receivable, inventory, property, plant, and equipment. These are items owned by the business that the business uses to help the business to generate revenue, which is also known as sales. Excellent, very well done. Who can tell me what is a liability? What is a liability?
Liabilities are obligations to transfer assets or provide products or services to others.
Was that Darius? Is that you, Darius?
Yes. Yes.
Okay, awesome. Thank you. Yeah, Darius, that's a great textbook definition of a liability. Absolutely. So liability is anytime the business owes money to someone else, right? Just as Darius, as you said with that definition, yeah, it's anytime the business owes something to someone else. Examples of that would be accounts payable, the bills we received, but if we have not yet paid them. So accounts payable, wages payable, taxes payable. Those are all short-term liabilities. Long-term liabilities would include things like notes payable, like a bank loan, a mortgage payable, a car loan payable, student loans payable. Those are all long-term things, greater than 1 year. So yes, that's a wonderful definition, Darius. Thank you. Now, who can tell me what is equity? What does that mean?
Is that on the assets of a business?
L'Oreal, one more time.
Is it the claims on the assets of a business?
Yes, that would be the textbook definition of equity. And what L'Oreal means by that is that it's what the owners of the business own. Okay, so it would include things like paid-in capital. That's when the owners of the business invest cash and other assets into the business. When they first form the business or when a new partner joins the business, yeah, absolutely. Other forms of equity include things like stock and bonds. Stock is a form of ownership where individuals have shares of stock in the business. So that's also a form of equity. There's a couple of other things within equity that, as you know, from the expanded accounting equation, and that would include net income, which is a part of equity, right? It goes onto the retained earnings statement. So ending retained earnings is a form of equity. So yeah, wonderful. Thank you all so much for helping me to recall what we learned about on Tuesday. So thank you all so much. It's important that you remember the assets equals liabilities plus equity accounting equation because every transaction that we identify impacts that accounting equation, right? And as you probably recall from Tuesday, we talked about the various transactions that and how they impact the accounting equation. And so today we're going to dive a little bit deeper on that concept, and we're going to look at it from the perspective of the individual transactions and how they translate to the accounting equation and ultimately find themselves on the income statement, balance sheet, statement of cash flows. Okay. So let's talk about what is a transaction and how do we record it. So a transaction represents an economic event. It's basically says, hey, this thing happened where there was an exchange of goods and services for something else. And that something else is usually like cash or a check or something along those lines, right? So that's what a business transaction is. It's the process that we go from transactions and events to financial statements. And this is what it includes. This is the process of identifying a transaction. First, we identify the transaction based off of the event that has occurred. And we do that from what we call source documents. A source document is a document that reflects the transaction. This would include things like an invoice, a packing slip, receipt. These are source documents. Okay, they represent the transaction that occurred. We analyze the information on those source documents using the accounting equation, just like we talked about on Tuesday. So we look at the two or more accounts that are being affected from this transaction. And then we record that relevant transaction using what we call a general journal. The journal is kind of like a ledger, yeah? So we post the journal on a ledger, or what we call ledger accounts. And we prepare and analyze a trial balance and financial statements based off of all of the transactions together. And so that's kind of like the process of analyzing a transaction and posting it. And so we're going to dive much deeper into these 5 steps, if you will. So, as I had mentioned earlier, a source document is a document that identifies a transaction. And source documents include things like a bill, sales receipt, check, purchase order, payroll record, a bank statement. These are all what we call source documents, and they contain information that reflect transactions that have occurred. We take that information and we record the transaction. But before we do that, we need to understand what accounts are being affected. And the best way to do that is to understand what the transaction was. That way we can figure out what accounts need to be recorded. And as we talked about briefly on Tuesday, is that an account is a record of an increase or decrease of an asset, liability, or equity. So we record that account on what we call a ledger, general ledger, which is a record of all accounts and their balances. So I want to think of like a transaction. We would write it out using 2 accounts. That's the transaction that we're recording to those accounts. And we do that in a very large piece of paper. It's called a general ledger. And so for every transaction, we record those accounts. Yeah. The general ledger, what that does is it tracks the balances of all of those accounts. And thinking about what we talked about on Tuesday, and we just did a great exercise of this a few minutes ago. We identified the individual asset accounts, liability accounts, and equity accounts. As we mentioned, asset accounts are what the business owns. Cash, accounts receivable, notes receivable, inventory, prepaid accounts, supplies, equipment, buildings, and land. It's broken out a little bit more than that, but that's the general specifications of asset accounts. Cash, as you know, is used to invest back into the business, to grow the business. Accounts receivable, that's when a customer owes the business money from a sale that was made. We delivered the good or the service. The customer has not yet paid us. So that's what we call an accounts receivable. A note receivable is a little bit more complex than that, but it's similar to an account receivable. A note receivable is when the customer hasn't paid us for a while, like 90 days, okay? So the way it works is that the customer had an account receivable with us. The customer didn't pay us in 30 days. So another 30 days goes by. Customer still hasn't paid us. Now they're late. So what does the business do? The business converts the account receivable to what we call a note receivable. And a note receivable is kind of like a short-term loan that the business is making to the customer. So hey, it's kind of like a line of credit, if you will. And so the customer has to pay back the original account receivable balance plus interest to the business. That is what we call a note receivable. It's not terribly common, but it's common enough for us to talk about it. So don't worry so much about note receivable. I just want you to kind of understand what it is. Inventory, of course, are the products that the business sells. The inventory that the business sells to the customers. The products, the goods. Yep. That's what inventory is. Prepaid accounts. Let's talk about this for a second. A prepaid account is when the business prepaid expense. Okay? Here's a couple of examples. My favorite example to use in prepaid accounts is prepaid insurance. Prepaid insurance works like this. Let's say you get a bill for the car insurance or the homeowner's insurance. And the insurance company says, hey, we'll give you a little discount if you pay for the whole year up front. Makes sense to me because I like a discount just like the rest of y'all do. So I'm going to say, yeah, that sounds great. I'll pay the entire year of insurance up front. The business, we call that prepaid insurance. I'm paying an entire year's worth of insurance up front before the year starts. That's what makes it prepaid. I paid in advance of the consumption of that expense. Instead of paying the insurance every single month, on the first of every month, I'm paying for it up front. Okay, a year in advance. We call that prepaid. You paid before it actually occurs. Okay, that's prepaid. The reason why that is an asset, not just an expense, is because to the business, I can take that back. Meaning, if I decide, hey, you know what, I don't like this insurance company anymore, I can request a refund. Yeah, I can take it back. That's why it's an asset to the business. It becomes an expense over time as it's being used. You see? That makes sense to everyone? Prepaid account? Good. Awesome. Cool. It gets a little complex, so that's why I wanted to take some time to explain it to you. Because when you see the word prepaid account, it's not always obvious. Yeah. Supplies are can be inventory. Some businesses call supplies inventory. Other businesses call supplies as small parts of, I guess you'd call it's like the boxes and the packing materials and those type of supplies. The reason why that might be considered an asset for certain companies is because it's used in the delivery process of the inventory. Therefore, it's part of an asset. I'm stretching there, I know. Supplies and inventory are very similar to each other. Yep. Property, plant, and equipment. You hear me use the word plant instead of building. A plant is like a facility where we manufacture things. Yeah, it's got the big smokestack and all that. That's a plant. Okay? It's a building. It's the same thing as a building. Property, plant, and equipment. I use the word property instead of land. Property and land are the same thing. It's the dirt that the building sits on. Land. Property, plant, and equipment are what we call fixed assets, also known as long-term assets. The reason why we call these long-term or fixed is because we use the land, the building, and the equipment to produce our inventory, to make our inventory. And so therefore, we call them fixed assets. They're long-term assets. We don't sell them every year. We use them for multiple years. With liabilities, we have accounts payable. That's when that's when we received a bill, but we have not yet paid it. An example is, I received my Pepco bill the first of the month. I haven't paid it yet. It's an account payable. I'll pay it later. Accounts payable. Received a bill, haven't paid it yet. Notes payable. That's a loan. If the bank gave me a loan, I pay them back over time. Notes payable are typically long-term, greater than 1 year. Accrued liabilities. Accrued liabilities are things like wages payable, taxes payable, benefits payable. All my HR people in the room. These are what we call accrued liabilities. We've accrued them, meaning our employee worked for 2 weeks. They accrued 2 weeks worth of hours. Okay? I haven't paid them yet. It's an accrued liability. So we're basically adding up the time and time and time. It's accruing. That's what accrual means. And then you'll also notice the fourth one, it says unearned revenue. Unearned revenue, we talked briefly about that on Tuesday. Remember my lawn service company? So I was mowing some lawns. And, I had Leland as a customer, and I had Darius as a customer, and I mowed their lawns. And I asked the two of them to pay me up front before I mow their lawn each month. That's unearned revenue to me. It becomes earned revenue after I perform the service, right? So it's unearned revenue. Customer pays you before you provide the service. The reason why that's a liability is because that customer can always ask you for a refund. You got to pay that money back. That's why it's a liability. It becomes earned revenue after you've performed the good or the service. For equity, you got owner's capital, which is also known as paid in capital. That's where the owners invest capital into the business. Capital could be either cash or equipment or buildings or land or whatever. Investing assets into the business. We have to allocate that investment to the owners. Because remember, the accounting equation has to balance. Yeah, owners' withdrawals, that's when the owners take money, cash, out of the business. For whatever reason. They want to go shopping in person. They want a personal monies from the business. That's fine. Owners withdraw out of the business. And then we have revenue minus expenses equals net income. Equity accounts, yeah. So to break it down a little bit further, our asset accounts are things that the business owns. Cash, accounts receivable, notes receivable, prepaid accounts, supplies, equipment, buildings, land, etc. Liabilities account, these are things that the business owes to someone else. Accounts payable, notes payable, unearned revenue, accrued liabilities. Equity accounts, these are what the owners own. Owner's investment into the business, we call that owner's capital or paid in capital. Minus owner's withdrawals. Plus revenue minus expenses, which equals net income. This expanded equity is the expanded version of the accounting equation. We talked briefly about this on Tuesday. Paying capital minus owner's withdrawals plus revenues minus expenses. That equals total equity. Revenues and common stock equity increases equity. Expenses and dividends that are paid out decreases equity. Makes sense. Increasing equity, that's money coming into the business. Sales and common stock that we've sold. What decreases equity are the expenses, because it's cash coming out of the business, and dividend payments that we make to the shareholders. That comes out of the business too. Okay, now that we talked about the expanded accounting equation, you have a better idea now of what's involved in each type of account. What are the accounts? Where do they belong to? The reason why we go through that exercise is because it's important for you to understand different accounts that belong to every single business. Every single business has a cash account, accounts receivable, supplies, prepaid insurance, equipment, etc. All businesses have these. Most businesses have those. Most businesses also have accounts payable, unearned revenue. And a lot of businesses have paid in capital or owner's equity accounts. All businesses have some kind of revenue. All businesses have expenses. We collectively call that the chart of accounts. The chart of accounts is a list of every single account that the business has, and it's listed out in the order of liquidity. Here's what I mean by that. Liquidity is the ability to convert something into cash. Liquidity is the ability to convert something into cash. You'll notice that on the chart of accounts, the first thing is listed as cash. It's the most liquid. I can use cash for cash. I can use cash to pay bills. Yep. I can use cash to invest in the business. It's liquid. I can move cash around. It's liquid. Okay. Liquidity. Second thing listed is accounts receivable. I can sell my accounts receivable, or my customers will pay that back. That's relatively liquid. And then is supplies or inventory. It's getting a little harder now, but I can still sell my inventory, so I can convert that to cash. Prepaid insurance, I can get that money back. Equipment, it's hard to sell equipment and buildings and land. It's not easy to convert that into cash right away because it takes time. It takes time to sell that kind of thing. Like you see how it's ordered in the level of liquidity. Yeah.
Professor?
Yes, please.
So the orders kind of like it's based on how easy it is to get. The cash is,
Yeah.
easier than okay.
Exactly. You got it, Leland. It's organized by. That's what liquidity means. How quickly we can convert something into cash. And so you'll notice that the assets and even the liabilities are listed out in the order of liquidity. How quickly we can convert it to cash. Yeah, very well done. So that's the chart of accounts. It's a list of all your accounts, and it's listed out by liquidity. That's why those little numbers you see, 101, 106, 126, 128, 167, so forth and so on, represents the different categories. So everything that starts with 100, that's an asset. 200, that's a liability. 300, that's equity. So forth and so on. That's the whole, that's how the numbering system works. It's just a number, but it's a number that's used to track the account. Each account has a number associated with it. When you look at a chart of accounts, you'll see it all just listed straight out. Yeah? Chart of accounts is very important in that respect. That's kind of the basics of it. We talked briefly on Tuesday about debits and credits. And I'm sure you heard me say that every time we were looking at the transactions, remember? I said, oh, debit this, credit this. Debit this, credit this. And some of you were like, what the hell is a debit? What's a credit? So a debit is on the left side of the account and a credit is on the right. Basically what it does is it shows us what's going up and what's going down. Because remember the accounting equation, assets equals liabilities plus equity. Assets has to go either up or down. Liabilities has to go up either up or down. And same with equity, right? Because assets needs to equal liabilities plus equity. That's the accounting equation. It has to always balance. And so every transaction has two accounts. Every transaction has a debit and a credit. One account is being debited, the other one is being credited. And typically, not always, but typically, one's an asset, the other's either a liability or equity. It's the typical type of transaction. Sometimes it could be only assets. Oh, I received cash from my customer who's paying their accounts receivable. So cash went up and accounts receivable went down. They're both asset accounts, right? So that I'm just trying to explain to you how the debits and credits parts work. every transaction, it always starts with debit and then credit. Always debit first and then credit. It's the order. Yeah. It's the normal order of a transaction. We use T accounts. You'll see that's why they call it a T account, right? It's got on the left side is debit, on the right side is credit, and on the top is the account title. It's shaped like a T. That's why they call it a T account. What a T account is, it's a ledger. It shows you the effects of each transaction, the debit and the credit. Now you'll notice, and this is kind of what we talked about yesterday, Tuesday. Assets equals liabilities plus equity, that's the accounting equation. Every transaction has a debit and a credit. And you'll notice that debit increases assets. A debit also increases liabilities and equity. Look at the accounting equation. Assets equals liabilities plus equity. Notice how debit increases assets and also increases liabilities and equity. Notice how it flipped from being from one side to the other. So debits increase assets. A credit will decrease assets. For example, I received cash payment from my customer who purchased on account, meaning the customer purchased using accounts receivable. They paid me 30 days later. So now I'm receiving the payment. I debit cash because the customer gave me cash. I credit accounts receivable to decrease the account receivable. They're both asset accounts. But you see how that works. To increase the asset, I debit. To decrease an asset, I credit. Liabilities, to decrease a liability, it's a debit. To increase a liability, it's a credit. Here's an example. Let me think here. The company took out a loan. And we took out a loan for $10,000. Here's the transaction. I debit cash $10,000 because I got $10,000 from the bank, right? Debit cash $10,000. I'm increasing my cash balance by $10,000. So I'm increasing my asset. It's a loan, right? The money came from a loan. So the second part of the transaction, the credit account, is notes payable. So debit cash, $10,000. Credit, notes payable, $10,000. Notes payable is a liability. I've got to pay that money back. It's a loan. So I'm increasing my liability. There's an example. Another example for liabilities. I'm paying my Pepco bill. Okay. Wait, paying your Pepco bill. I debit accounts payable. Decrease the accounts payable. I credit cash. Decrease my cash. See? It's always going to balance. Assets still equals liabilities plus equity. You see? Then take a look at the equity part. A debit decreases equity. A credit increases it. An example. At the end of the year, every business closes out their temporary accounts. Those are the accounts on the income statement. We bring them back to zero. And the way we do that is through what we call a closing process. We're going to talk a little bit about that probably in the next chapter. The way it works is I close out my temporary accounts to my net income. Okay. Remember, net income That's the thing that on the bottom of the income statement. Revenue minus expenses equals net income. And you remember revenue and expenses, well, that's a part of equity. Revenue minus expenses equals net income. Net income is an equity account. And so at the end of the year, end of the month, I close out my temporary accounts. And so I close net income out to my retained earnings. That's an equity account. And as long as it's positive, it's going to be a credit. I'll debit sales. I'll credit net income. See how that works? Just a couple of examples. The more, again, the more you practice things, especially with accounting, the better off you'll be. So for these kind of things, I do recommend the Excel exercises. I think you'll find those to be really helpful when it comes to learning more about these debits and credits kind of things, you know. Okay, so as you know, here again is the accounting equation expanded. Assets equals liabilities plus equity. The equity expanded out looks like this. We got owner's capital, owner's withdrawals, revenues, and expenses. You'll notice that within the equity section, increase owner's capital, meaning the owner's putting money into the business. To increase that equity, it's a credit. And so the example for that is the owner invested $10,000 into the business. So we debit cash $10,000. We credit owner's capital $10,000. Owner's capital is a part of equity. Accounting equation still balances. If the owner takes money out, well, it's just, also very simple. Let's say the owner took out $200, like remember from chapter 1. We would debit owner's withdrawal $200 and credit cash $200. It's bringing equity down. What about revenue and expenses? It kind of goes back to my earlier example about when we close out the accounts. Yeah. So just things to think about. Leland, please.
Oh, I was just gonna say, could you repeat that? You said if you take out $200 of your personal account and put it into the business, that would be what again? Would you say?
Yeah, so yeah, you're on the right track. So what I was saying was, well, there's two examples I gave. The first example was the owner invests $10,000 in cash into the business. In that example, we would debit cash $10,000 because the owner's putting money into the business. So to increase cash, we debit it. So debit cash $10,000, we would credit owner's capital $10,000.
Equity part.
Yeah, exactly. And what
Okay,
it does is it basically represents, hey, the owner put cash in, and we got to give the owner credit for that, right?
Yeah.
So that's why we call it a credit. We're crediting the owner's account that 10,000.
Yeah, it keeps everything balanced.
You got it exactly.
Okay. Thank you very much.
You're very welcome. And then this, of course, the second example was the owner took out $200 out of the business, and so in that case, we would debit owner's equity. I'm sorry, owner's withdrawals $200. We credit cash $200. Yeah.
Okay, that's just the reverse.
Exactly. That's exactly right.
Thank you.
Yeah,
Thank
you're very welcome. Great question. Okay, so now that we understand the accounting equation and the different accounts that go into each category, and we kind of have an okay understanding of debits and credits, let's talk about what we call the double entry accounting system. Double entry accounting system simply means that every transaction has two accounts, a debit account and a credit account. And we can visually see those accounts using the T accounts, what we call a T account. A T account is a ledger for that individual account, and it shows us what came in and out of that account on a daily basis, right? To help us to find the balance. Here we have an example of cash. Cash is its own account, as you know, and cash goes up and it goes down depending on what's happening, right? So we know that in order to increase cash, we debit cash. To decrease cash, we credit it. And so here we see the example. On the left side, the debit side, we received an investment from the owner, $30,000. We received consulting service revenue, $4,200. We received accounts receivable collection from an earlier account receivable for $1,900. All that is cash coming into the business for a total of $36,100. Now what's going on the right side? That's cash going out of the business. We purchased supplies, we purchased equipment, we had to pay for rent, we had to pay our employees' salaries, we had to pay some bills, accounts payable. Oh, and the owner took some money out too, right? We add up all of our credits, $31,300. So that's how we find our balance. We take what came in, our debits, minus what went out, our credits, to equal the balance. In this case, $4,800. The normal balance of an asset is always going to be a debit balance. The normal balance of an asset is always going to be a debit balance. What I mean by that is assets normally have a debit balance. Okay? It just means that it's positive for an asset. Yep. Let's talk about the transactions and how they impact the financial statements. As we mentioned earlier, the first thing we do to figure out if a transaction happened is we look at the source documents. This would include things like a bank statement, purchase order, sales receipt, a bill, a contract, the original documents, yeah? We analyze what happened on those statements, on those source documents. We analyze them, figure out what happened, right? We figure out the impact on the accounting equation. This third thing we do is we record the transaction. We figured out what the debit is and what the credit is and what the impact was from the accounting equation. And then when we record those entries, those journal entries, we do what we call posting them to the general ledgers, which is those key accounts we were talking about earlier. That's the process. Let's take a deeper look at what is a journal entry. A journal entry is the transaction. It's the debit and the credit. Okay, here's how it looks typically. The date that the transaction happened on. That's the first thing we write down. What's the date? And then the second thing is we write the debit account. In this example, cash. The owner invested $30,000 in cash. We debit cash. So we write cash as the debit account, and we debit $30,000. The third thing we do is we write the title of the credit account. In this example, owner's equity or owner's investment. Yep. Owner's capital. Paid in capital. So we write the name of the owner, capital account. We credit the $30,000. Then the last thing we do on most entries, journal entries, is we type in a little note. What was it for? Yeah. Letter D is the note. What was it for? You know. And we do that for every single transaction. It's a very simple process. The great news is because, it's 2023 now, a lot of businesses will use software for this. like QuickBooks, Sage, Oracle, a couple of other larger pieces of software out there. It's accounting software. And the way it works is, instead of, really nobody's typing out these entries anymore. Artificial intelligence is doing that for us. What we do is we typically take a picture of a receipt or of using our phone, and we put it into QuickBooks, and it automatically populates it for us. So that's the modern way of doing it.
Oh,
Go ahead.
Professor, so you're saying that you don't have to type it even in the computer or anything no more? They have systems where if you just
Oh yeah. They've come a long ways. Artificial intelligence is really changing the game, if you will. But the reason why I show you these types of things is because I want you to understand how it works, right? Not just don't rely on a computer to do it for you. I want you to know how it works. Yeah. Because the reality is, the more you know about how artificial intelligence works, you can help to identify the errors that it makes, because it's not perfect. It's just like any other machine. It's just not going to be perfect. So we've recorded the transaction. Now we need to look at the balances. We got to identify the balances, and we do that through what we call the T accounts. So we look at each individual account and the general ledger. In this example, we're looking at cash. Cash came into the business on December 1 from the owner who made an investment of $30,000. Cash went out of the business on December 2 for the purchase of supplies. Cash went out of the business on December 3rd for the purchase of machinery or equipment. And then cash came into the business December 10 because we collected cash from a customer from an account receivable. Those are the transactions that happen, remember? And so you'll notice on the right-hand side of our ledger for our cash account, the balance. Yeah, up 30,000, down to 27, down to 1,500, and then up to 5,700. Yeah, it's reflective of the cash coming into and out of the business. So that balance, this 5,700 on December 10, is what you would see on your balance sheet on December 10. So this shows you how we post those general journal entries. We typed in the account, the transaction, 2 accounts, and then we can see how that transaction posts to the general ledger. So you see how it affects the different accounts, yeah? That's what this is trying to show you. Really 4 steps to posting a transaction. First, we use the source documents from like the bank statement, the receipts, the transaction documents. Second step is we analyze those transactions using the accounting equation. Was it an asset account, liabilities, equity, what were they? And when we've identified what those accounts are, then we record the transaction using a general journal entry. Then the last thing we do is we post that general journal entry to our general ledger, which are our T accounts. Yeah. So step 1, identify what it was. So in this case, in that first transaction, the owner invested $30,000 into the business. So we figured out what that was. Step 2, we analyze what happens to the accounting equation. We increase assets by $30,000 and increase equity by $30,000. So debit cash, credit equity, $30,000. Then we post that transaction to the general journal. 30,000 went up in cash, 30,000 went up in equity. Second transaction, we purchased supplies for 2,500 or inventory 2,500. So we increase our inventory supplies 2,500. So we debit supplies and we credit cash 2,500 because we use cash to pay for it. And we see how we post that supplies went up, cash went down. Third transaction, we bought equipment for 26,000. Equipment asset goes up, cash asset goes down. Debit equipment 26,000, credit cash 26,000. And then we see how that posts to the general ledgers. Purchase supplies on account. We purchased supplies on account. When you hear me use the word on account or on credit, that you should automatically think accounts payable. He's going to pay it later. So we debit supplies 7,100. Credit accounts payable 7,100. And then you see how that posts. Transaction 5. We provided services for cash. Okay, did some consulting, customer paid us right away. 4,200. So debit cash 4,200. And credit consulting revenue. Revenue sales, yeah. 4,200. And they post those to the individual accounts. All right, a little blurry. I don't know what happened there. I'll read it to you, don't worry. We paid an expense in cash. We paid $1,000 for rent. Okay? You're a landlord, here's $1,000. So we debit rent expense 1,000, credit cash 1,000. We post those to the ledgers. A blurry slide. We paid another expense in cash. We paid our employee $700 for their hard work. We debit salaries expense $700 and we credit cash $700 and we post those to our ledgers. Transaction 8. We provided consulting and rental services on credit. There's that word on credit, meaning the customer is going to pay us later. Okay? So, the customer is going to pay us later. That means accounts receivable. So I debit accounts receivable $1,900. Then I credit my 2 revenue accounts. Some of it was consulting, and the rest of it was rental. Consulting revenue, $1,600. Rental revenue, $300. You see the debits still equal the credits, $1,900 equals 16 plus 3. Yeah, $1,900. So, and then I post to the general ledgers. Dylan, please.
Professor, just so that way I'm following, you said account receivable is if your customer owes you or is going to pay you in the future. And accounts payable is when you're going to pay someone else in the future.
You got it.
Okay. Yeah. Thank you.
Very well done. Yep. Very good. Good question. Transaction 9. Okay, nice. It's a little bit more clear. I can read this one. Receipt of cash from accounts receivable, meaning our customer that we provide the services to earlier, they said, hey, we'll pay you later. Now they're paying us. Okay, here we are a couple days later, they're paying us $900 for the services we provided. So we debit cash, $1,900, and we credit accounts receivable, $1,900. You see the cash went up, their accounts receivable went down. because they paid us. We post those to the ledgers. Transaction 10, a little bit more blurry. Partial payment of accounts payable. Yeah, I owed more than $900, but I'm only going to pay him $900. So this comes from transaction 4 earlier on. Remember, I bought $7,100 worth of supplies on account back in transaction 4. Well, now I'm going to partially pay my vendor, pay them $900. So I debit accounts payable $900 to reduce the payable. And I credit cash $900 to reduce my cash. I post to my ledger accounts. Oh, sorry. Transaction 11. The owner took out $200. Okay, that's cool. No worries. We debit owner's withdrawals $200. That's an equity account, as you remember. And we credit cash $200 to reduce the cash. And we post those to the ledger accounts. Transaction 12. We received cash for future services. Okay, this is where reading the transaction is really important. It says future services. When I hear the word future, it means I have not yet performed the service. Future services. They will happen in the future. Hasn't happened yet. So I can probably know that it's going to be unearned revenue. So what happened? We received $3,000 in advance of providing consulting services for a customer. The customer paid us up front before I provided the service. That's good and bad, right? It's good because I get the cash up front. It's bad because if I don't do the service, I got to pay them back. So I debit cash $3,000 because I received the cash from the customer. And then I credit an account called unearned revenue. Remember, it's unearned because I haven't done it yet. I haven't provided the service yet. It becomes earned when I provide the service. I post those to the account, the ledgers. 13. I'm going to pay cash for future insurance coverage. This is my earlier example, remember? I like to pay a whole year's worth of insurance up front. So do businesses, because it's usually cheaper to do that over the long run. So the company's paying $2,400 in cash up front for insurance that covers 2 years, 24 months. Okay? Coverage begins on December 1. So, what we do here is we debit prepaid insurance. That's an asset account. The reason why prepaids are asset accounts is because I could always say, hey, you know what? Never mind. Pay me back, right? That's why it's an asset. Prepaid insurance, debit $2,400. Credit cash $2,400. Reduce the cash. Post to the general ledgers. Transaction 14. We purchased supplies for cash. Just a simple cash transaction. Went to the store, bought $100 worth, $120 worth of supplies. So I debit supplies $120, credit cash $120, and post it to the ledgers. Transaction 15. Payment of expense in cash. We paid our utility bill. It's with cash. We received the bill, paid it right away. Doesn't even touch accounts payable because I paid it right away. If I waited, then it would be accounts payable. If I received the bill, paid it right away. It's just cash. Yep. So I debit utilities expense 305, and then credit cash 305. And then post it to the ledgers. Payment of expense in cash, $700, paying my employees. Okay. I debit salaries expense, 700. I credit cash, 700. Post in the ledgers. Okay, so we just went through 16 transactions in pretty short order. And so once we've posted all of our transactions to the ledgers, it's time to look at those ledgers through the general ledger. It shows us all of the subsidiary ledger accounts, all of our T accounts, right? Take a look at cash. Almost all of our transactions, not all of them, but most of them involved cash. And you can see all of the cash that came in on the debit side and all the cash that went out on the credit side. So, in order to figure out what our balances are for each account, we take our debits minus our credits to get the balance. Make sense? So, we add up all of our debits, and then subtract that from our credits to get the balance. Our cash balance is $4,275 after all 16 of those transactions. Accounts receivable is 0. We paid up. The first transaction 8, we bought supplies on account. Transaction 9, we paid it all back. So accounts receivable 0. I'm sorry, accounts receivable. Our customer purchased services on account, then they paid us. That's why their accounts receivable 0. Supplies. We bought a bunch of supplies. We haven't used those supplies yet. So that's why you see it all on the debit side. $1,720. Prepaid insurance. We prepaid insurance for 2 years up front, $2,400. Haven't used it yet. We'll use it at the end of every month for the next 2 years. Equipment. We bought equipment, $26,000. It's very straightforward. You won't see a whole lot of activity in equipment accounts because it's not like we buy and sell equipment. That's not what we do. Okay, so that's all your assets. On your liabilities, we have accounts payable and unearned revenue. Accounts payable. We took out $7,100. We bought $7,100 worth of supplies on account. We repaid $900 of it in transaction 10. So we take our credit balance minus the debit balance to get the credit balance of $6,200 that we still owe on accounts payable. In consulting revenues, $3,000. I haven't performed the service yet. Under equity, the owner invested $30,000 in cash on day 1. So credit balance, $30,000 for the owner. Transaction 11, the owner took out $200. So we debited $200 from owner withdrawals. And then we have our revenue and expenses. Revenue, we always debit revenue. We always credit revenue to increase revenue. Yep. We always credit revenue to increase revenue. We always debit expenses to increase expenses. Those are all of our temporary accounts from the income statement. And so you can see that once you've added up all of your debits and credits, the total assets were $42,395. Total liabilities was $9,200. Our total equity was $33,195. So if you add the 33,195 plus the 9,200 from liabilities, that equals 42,395. So your accounting equation always balances. Make sense? We do okay? Right? Okay, just want to make sure. All right, let's keep on. So once we've identified our T accounts and we got everything balanced out, next thing we want to do is prepare the financial statements using that trial balance. So here's how that works. 3 steps. First is we list each account title and the amount from the ledgers for the trial balance. Yep. So each account, in the order of the chart of accounts, list them all out and their balances. The second thing we do is we compute the total debits and the total credits. And we make sure the total debits and the total credits equal. Yeah. That's why we call it a trial balance. The trial is that we're making sure, proving, that debits equal credits. Making sure that our total debits equal our total credits. And so here's an example of our trial balance based off of all those transactions that we did, the 16 transactions. We listed them out in the order of liquidity. All right, we listed out all of our debits and credits, the balances, and we add them all up. We make sure total debits equal total credits. That's the idea of a trial balance. That's what it does for us. It makes sure that our total debits equal total credits. It helps us to make sure we didn't make any errors. Because if you made an error, that ain't gonna balance. Yep. So how do we search for errors? If it doesn't balance, if the debits don't equal the credits, there's a problem. Yeah, that's the reality of it. So if debits don't equal credits is a problem. We have to recompute everything, find the errors, and then fix them. And that's how it works. So based off of all our balances that we got from our trial balance, we can then create the balance sheet, the income statement, statement of equity, balance sheet, and the statement of cash flows. So it's important to know that, and we talked briefly about this on Tuesday, the balance sheet represents any point in time. It doesn't have to be at the end of the month, at the beginning of the month. I look at the balance sheet and know what my balances are. Any point in time. That's different from the income statement. The income statement, you only find your totals on your income statement at the end of the accounting period, the end of the month, or the end of the year. That's when you know what's going on in your income statement. Same with cash flows and owner's equity. We only know at the end of the accounting period what the balances are. You see? Okay, so the financial statements. You've heard me say this a bunch of times, so I'm going to keep saying it. The income statement, balance sheet, statement of cash flows, statement of owner's equity. Here's what they are. The income statement shows all of your revenue, all of your expenses. Revenue, sales, yep. Minus cost of goods sold equals gross profit minus all your expenses equals net income. That's the format of the income statement. I'm going to show you what that looks like here on the next slide. The owner's equity, it shows you changes in equity for the accounting period. Owner's investments minus withdrawals equals ending balance equity. The balance sheet shows you the balances of all of your assets, liabilities, and equities. All your asset accounts, liability accounts, and equity accounts are all listed out in the order of liquidity. Assets on the left, liabilities and equity on the right, and the balances. You can see it at any time. And the fourth financial statement is called the statement of cash flows. This shows you the changes of cash coming into and out of the business for operating activities, investing activities, and financing activities. I'll show you what all that looks like. So let's take a look at the income statement for our business for those 16 transactions that we went through. Revenues. Consulting revenue was $5,800. Rental revenue was $300. Our total sales, total revenue, was $6,100. Then our expenses. Salaries expense, we paid our employees $1,400. Rent was $1,000. Utilities, $305. Add up all your expenses to get total expenses of $2,705. We take our total revenue minus your total expenses equals net income. So revenue, $6,100 minus total expenses of $2,705 equals a net income of $3,395. What does it look like on this statement of owner's equity? Owner's equity, December 1, the owner invested $30,000 into the business. Okay. At the end of the accounting period, the net income was $3,395. We put that on the statement of owner's equity, because remember, net income is equity. We add that to what the owner has already invested. So the total net income comes to $33,395 minus the $200 that the owner took out of the business equals the ending balance of owner's equity, $33,195. And what does it look like on the balance sheet? We have cash at $4,275, supplies at $9,720, prepaid insurance $2,400, equipment $26,000. Our total assets is $42,395. Liabilities, we have got accounts payable balance of $6,200, $3,000 unearned revenue. Liabilities is $9,200. Our owner's equity that we got from the statement of equity, $33,195. So we take the $33,195 plus the $9,200 to give us a $42,395. Assets equals liabilities plus equity. The accounting equation balances. So it's also so important that we don't just know how to show balances and show the revenue and expenses and all that stuff. We need to also be able to analyze that information. So when we analyze the information, what we're doing is we're trying to understand the overall financial health of the company. And one of the ways we do that is through ratios. Ratios help us to analyze the financial health of the business from a very quick perspective. I can quickly compute a ratio and it'll tell me something about the business. Here we have what's called the debt ratio. The debt ratio is something that banks or lenders typically use in order to understand if the company will have the ability to pay debt in the future. This same ratio is what the bank runs on you when you go to get a car loan. That's why it's important, not just in business, but in personal life, to understand these kinds of ratios. So here we have the debt ratio. It's total liabilities, what the company owes, divided by total assets, what the company owns. Okay, so we take total liabilities divided by total assets to get the debt ratio. Let's apply that to our earlier example. Or let's apply it to Costco and Walmart, whatever. Here we go. The current year, we got liabilities of $29,816 divided by total assets of $45,400. A debt ratio of 0.66. That's good. Okay. Anything lower than 1 is good, right? We want to make sure that our total debt is nowhere near our total assets, right? So anything lower than 1 is good. That, my friends, brings us to the conclusion of chapter 2. I want to know from y'all, are there any burning questions about what we just learned? Anything at all? All good?
Professor, I just want to, the last thing you said about the debt ratios, you said banks will run that on a business to make sure, to see if you are a business they should give money to, so that way how much you can pay it back and stuff like that.
Exactly. They want to make sure that you have the ability to repay the debt in the future. Yeah, that's absolutely right. And banks actually run this same ratio on individuals as well.
Do they do the same thing, for example, if you wanted to buy a home?
Absolutely. Yeah,
Okay.
absolutely. Because they want to make sure that you can pay that home loan back.
Got it.
Yeah,
Okay.
absolutely. Great question. Yeah. Excellent. Okay, so just to quickly recap what is due on Sunday night. And again, I really encourage you to work a little early. I apologize, there's so much work in this course, and I know that it's not easy, but the reality is it's an 8-week course. So we still have the same amount of content as you would in a 15-week course or 16-week course. So that's why you feel like it's heavy. You're like, oh, Dr. B, you're killing me with all these things I got to do every week, and it's a lot. It's like, I know it's a lot. So I feel you, I do. But, just so you know, it's an 8-week course. So that's why there's so much we got going on every week. So what do you have to do this week? You got the Excel training through LinkedIn Learning. And that should be very easy for you, I think, because ultimately you're watching videos, okay? But if you are serious about learning Excel, this is an excellent training. So you go through and you watch all these videos, you'll notice that there's also exercise files. It'll help you to follow along, okay? Because we learn by doing, right? It's hands-on learning. It's so valuable to learn while you're doing things. And so that's why I strongly urge you to work through that. I think you'll find it really valuable. So watch all the videos, work through the exercises, and then at the end, I think it's about an hour and a half roughly. Obviously you can always stop and walk away and come back or whatever. You get to the end, when you get to the conclusion, after that last 28 seconds where the gentleman's wrapping up, it'll ask you, hey, do you want to download this certificate? You say yes. So you click on the download part. It downloads to your computer as a PDF. You'll save that, or it'll just be in your downloads file. And then you'll come back to the classroom. Whoops. You'll come back to the classroom and you'll upload it here. Okay? And I see that 6 of you have done it already, so thank you for that. So upload it there, and then I'll grade it. Yeah. And then the other things you got to do, chapter 2 discussion. We just wrapped up chapter 2. So you'll come in here, and what you'll need to do is, oh, and thank you, Leland. I see your post. Excellent. Very well done. So you'll answer these questions, right? And you want to do it in your own words, of course, and you want to respond to 2 of your classmates. So when like Leland did a wonderful job, great resource, got some sources here, responded to all the questions, very well done. Okay. So responding to the questions, I'm looking for about 1 to 2 sentences. Yeah, not it doesn't have to be anything crazy. And we got some sources. Wonderful job. So you write up your response like Leland did, and then you want to respond to 2 of your classmates. Now, please, if you can, I'd love for you to have your original response today, or definitely by tomorrow. Reason? Because you got to respond to 2 of your classmates. Hard to do that if you're all doing it on Sunday. Okay, so please jump in on this discussion as soon as you possibly can. And then, of course, you have chapter 1 quiz and chapter 2 quiz. They're each about 10 questions. Most of them are multiple choice. There's a couple of math ones in there, yeah. But the great news is you got 2 attempts. It's open book, open note, open whatevers, and you got 2 attempts. So there's no reason why you shouldn't, do perfect on all of the quizzes in this course. So please, I need you to accomplish those 4 things just as quick as you can. Definitely by Sunday night. I know it's a lot, and I apologize about that. Yeah, that's exactly it. A couple of questions I see here in the chat. Yes, it's L'Oreal. If you want to work ahead, go. Yes, absolutely. Please work ahead. I encourage you. Michelle, yes, you have to respond to 2 of your classmates. That's the same for all discussions, pretty much, that you'll encounter. The great news is I think this course only has the 1 discussion. You'll find in the other weeks it's similar, but not quite a discussion. Like next week, for example, we have what's called a hypothesis. What it is you'll watch a video and you'll do some annotations. A little bit more interactive. Great questions. Any other comments, questions, concerns I can help you with right now?
Yes, I have another question for the discussion. Another question for discussion too. Do you want us to choose 2 questions to answer, or you want us to answer all 5? Because I see you say please choose 2 learning objectives.
Yeah. Any of the 2 is fine. If you want to do more than that, that's fine too.
Okay, thank you.
You're welcome. And it looks like Carol's got it. Yep, I see 2 responses from Carol. She's got 2 out of the 5, and it looks like Leland's got 2 out of the 5. So yeah, 2 out of the 5 would be great. Question. Any other comments, questions, concerns? Are we all good?
Pastor, where is the course learning objective on there? Where's the course at the end of the sentence or the question?
Sure, yeah. So yes, so these help you to identify how. So these 1 through 5, these are the module learning objectives, and you'll notice that how it relates or how it's tied to the course level objectives. So basically what I'm doing is I'm showing you how what you're learning relates to the course level learning objectives for the course. And so you'll find those learning objectives in your syllabus, and you'll also be able to find those in the course map. It kind of shows you how everything's tied together. That's the reason why that's there. Does that help to answer your question?
Yes, thank you.
Cool. Thank you very much. Appreciate it. Any other comments, questions, concerns? Awesome. Well, thank you so much for your time today. I really do appreciate it. I look forward to your work on those 4 items you have to knock out by Sunday night. Please do the best you can to get them all done by Sunday night, because I tell you, I just don't want you to fall behind, because there's so much work to do in this class, and once you fall behind, it becomes challenging. So if you need help, like if you're like, Dr. B, I don't get this question on this quiz, can you explain this to me? Yeah, just shoot me an email, I'll explain it to you. Or set up office hours or whatever you want to do. But I will get back to you as fast as I can. That's how I work. So thank you so much for your time today. Appreciate every single one of you. I look forward to your great work. If you ever need anything, you can email me, call me, set up office hours. I got you. Okay, we're going to get through this together. We're all going to do great. And I know you do great things. So stay safe, wash your hands, do the right things. And I'll see you all again on Tuesday. Thank you so much for your time today. Appreciate you. Enjoy
Thank you
the
so
rest of
much,
your night.
Professor.
Thank
Have
you,
a good night.
Professor.
Thank you.
My pleasure.
on
Thank
Tuesday.
you. Take
Have a good
care.
night.
Take care. Good
Thank you,
night.
Professor. Have a good evening.
You too. Bye-bye.